I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people are worried about.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Canada can and will position itself to be a key supplier of energy to the world.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Below parity, recession fears and the energy crisis push the euro to a 2-decade low. Stocks in the red while global equities continue to slide after their worst rout in 2 months. Plus, OPEC on alert, crude gains after Saudi Arabia warns the alliance could cut production to support prices. Now, we did see a bit of a reversal. Nothing huge, but a bit more support on the markets that we did certainly at the start of the trading session an hour ago. We're also getting euro area August manufacturing PMI coming in at 49.7. It's a touch better than expected, mainly supported by Germany. But again, anything below 50 means there's still a contraction. If you look at services PMI, that's falling 50.2, so that's actually worse than expected. Now, the picture across the board for European stocks, pretty much unchanged. Again, traders really bracing from a lot more hawkishness from the Federal Reserve. We'll hear from Jay Powell a little bit later on Friday. S&P futures now gaining some 0.2%. We were speaking to Arlene Thomason, and really one of the things that we need to spend a lot more time on is a currency. Yesterday we touched parity, currently at 199.31, and this really goes back not only to energy supply in Germany, but also dollar strength, king dollar, and what that happens, or what happens with that next 6 months. The 10-year yield at 3.0109. Again, if you look at the change in the markets, and we'll get, I think, to the map shortly, it's very clear that the markets are expecting a lot of a hawkish stance from the Federal Reserve. Maybe not something that was priced in, but certainly energy shares amongst the only industry group today making some pretty big gains. This is also on the back of Saudi Arabia oil minister saying that they could cut production. The UK, you can see the FTSE down 0.2%. So markets awaiting clues on how hawkish the Fed will be as central bankers gather this week at Jackson Hole. We spoke to Stanford University economics professor John Taylor, who's at the very first conference 4 decades ago. Well, he says the Fed should be more communicative about where policy has to go.
I say 5% is where we should aim. That is not high by historical standard, that's for sure. You remember what it was in the 70s, but it could be higher. I wouldn't say absolutely 5. If inflation doesn't come down, then it may have to be higher. But I think inflation will come down, and we can stick it at a level like that. But let's get there first.
Now we're joined by Morgan Deladon, Head of Investment Strategy for Europe at Global X ETFs. Morgan, thank you so much for joining us. A lot of the focus is actually on equities, but it's all playing out on currencies. Like, what are the forces that could push at some point dollar to stabilize somewhat?
Well, actually, the euro dropping below parity is quite of a signal that the markets are expecting more hawkishness from the Fed. But one thing that should stabilize the pair would be a more hawkishness from the ECB as well. Because when you look at headline inflation in Europe, core inflation in Europe, they're all trending higher, and that is likely to trigger some more hawkishness from the ECB, and that should stabilize the pair.
So how hawkish are you expecting the ECB to be, despite some of these concerns, of course, about even a protracted and ugly downturn if energy prices go much higher?
I think for the ECB, the key input to inform their decision in terms of the size of the hike will still be core inflation in the near future, because when you look at services inflation, it's trending higher. So I do think the ECB might go for another 50 basis points increase. And that is something that is not currently priced in, because the market is more focused on the downturn on the economic side. But given the energy crisis in Europe, I do think that inflation will probably be more in focus at the ECB than actually the economic data.
Inflation definitely in focus everywhere because of the cost of living crisis. If there's enough support fiscally from countries, can we avoid the worst of a recession?
It's really hard to say. I think at the moment the stagflation scenario is becoming the most likely scenario in Europe, and that could happen actually before the end of the year. So stagflation is the main risk. Fiscal side can be countercyclical, but at this point in time, given the inflation data, it seems that it's pretty unlikely to have anything on top of what's already agreed on.
So, Morgan, overall, what are you most, when you look at the markets, what do you think is most being mispriced?
Well, this disconnect between, headline inflation and core inflation is something interesting I'm looking at. Because when you look at headline inflation, there is a likely risk that the market is seeing the Fed to remain hawkish, but headline inflation may have already peaked in the US, whereas we are probably quarters away from a peak in Europe. So this disconnect might trigger more hawkishness down the line from the ECB than the Fed. So yes, the market may have priced these dovish pivot early, prematurely, but perhaps by not too much.
Morgan, we have a great chart actually looking at what we're seeing in terms of energy and the fact that some of the energy panic is really also hurting Europe. But Valerie Tetel there putting some great charts together on the back of those flash PMIs. When you look at natural gas, power and coal, like this kind of chart, should traders, take action more than they have so far?
Well, this chart, it definitely shows the challenge from the ECB, a bit of a catch-22 where the ECB is trying to cap inflation. So far, the control over headline inflation has been complicated because it was mostly driven by energy prices. It could be still the case, but something that is also growing is the core inflation. So the ECB, that is the reason for the ECB to continue to hike interest rates despite some downturns. But all of these rise in European energy prices is saying that, yes, the peak headline inflation may be quarters, maybe for spring next year.
Morgan, thank you so much. Morgan Deladon there, Head of Investment Strategy for Europe at Global X ETFs, staying with us. Now, coming up, the German Chancellor Olaf Scholz visits Canada as his government works to reduce Germany's dependence on Russian gas imports. We have more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, German power has surged above 700 euros a megawatt hour for the first time as markets panic over the country's dependence on unreliable Russian energy supplies. Where the Chancellor Olaf Scholz went to Canada as a part of a push to find alternative sources of gas, and he emphasized that his government is working hard to end its dependence on Russian gas.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Easing the processes because of the difficulty that Germany is facing to make sure that we can move through regulatory hurdles more quickly is something we're willing to do. But there needs to be a business case. It needs to make sense for Germany.
Now, for more on all of this, we're joined by Bloomberg's Anna Shizerskayeva. Anna, I'm sorry, I butchered your name because it's a Tuesday in August. I will get it right, I promise. Anna, what alternatives to Russian gas actually does Europe have in the short term and longer term?
Well, indeed, in the short term, Europe's alternatives are quite scarce because it has to get LNG from the market, available cargoes that are already being produced. So it's up to the companies if they're able to supply these molecules to, for example, these LNG terminals that Germany is trying to set up. Now, longer term, it is possible to get new supply that's slated to come online after 2025. But as we've seen with Canada, for example, Germany is desperate in trying to secure the fuel from all available sources. Canada is quite tricky. On paper, you have East Coast of Canada quite close to Europe, just a few days of shipping. But the gas fields are on the West Coast, so it's very difficult to bring that gas from west to east. And there have been a lot of projects to build LNG plants in Canada for years, and none of them have moved so far. So we'll see if Germany's interest will push them forward. But as Trudeau said, it remains to be seen if there's a business case to actually build these LNG plants. And Germany's talks with Qatar are still ongoing. They're difficult as well. So it just shows it's not an easy task for Europe.
So, Anna, is there any ceiling to prices?
There is no ceiling actually. As you see, prices are now already more than 10 times higher than seasonal average for the summertime. And Energy Aspects said today that prices could go to 400 euros a megawatt. That's about 20 times the seasonal normal for this time of the year if Russia cuts supply completely in September. Now, the Nord Stream pipeline is going to be shut for 3 days from the 31st of August. And the risk is that the market is concerned that the pipeline will not come online after the maintenance. And so prices could surge higher if that happens. Now, the ceiling might come from demand destruction, because at these high prices we're already seeing industries are suffering and output is being limited. So we'll see the remain of these very high prices on industries, in particular, the chemical industry, in particular in Germany as well.
Anna, thank you so much. I'm going to try not to mispronounce your name. If I actually get it wrong, I'm going to pay you in megawatts, which will make you a rich woman in like a week. Anna Shirovskaya joining us on the very latest for energy prices. Now we're back with Morgane Deladon, Head of Investment Strategy for Europe at Global X ETFs. Morgane, we talked a little bit about, of course, the energy price. Again, it seems that when you look at equities, and I guess the problem with energy is that it's used for making everything. If you're making, for example, glass in Germany and the price goes up, you may also be shut down. Are the markets realizing this? Like, what exactly is priced in?
I think it's starting to realize it, because we are seeing headline inflation fueling into core inflation now. So we are seeing this pass-through effect. Now, in terms of equities and activities, we do see that there is a slowdown and a contraction now in Germany that will lower the gas demand and maybe reduce some of the demand and therefore some of the pressure on the price down the line. But there is still a risk in the short term because of the capacity of building reserve before winter in Germany seems quite challenging, despite lots of effort to try to see alternatives. So in the short term, I think there is still some options. LNG, we mentioned it before, but also like nuclear. There is also a chance that Germany reassess its view on nuclear power if there is a risk to the economy. So nuclear in Europe has been actually one of the first option for some other countries, the UK, France, and that could be something for the short term. Down the line.
So Morgane, talk to me a little bit. Yeah, down the line, finish your thought.
Yeah, down the line, it's more looking at investment in clean energies, renewables, and hydrogen.
Yeah, Morgane, what does it mean for the UK? So we had this pretty incredible call by Citi saying inflation could hit 17%, really mainly because of the cost of living crisis due to this energy.
Well, in the UK, on top of having an energy crisis, you also have a Brexit effect, and the UK imports a lot. So there is still maybe in terms of the stagflation scenario, it's even bigger in the UK compared to continental Europe. That is for sure. But in terms of projecting inflation, it's really hard to say because there are lots of moving parts on the energy side, and it will all depend on what is the solution in the near term. Do we increase nuclear capacity, or are we reducing demand?
All right, Morgane, thank you so much for joining us. Morgane Deladon, their Head of Investment Strategy for Europe at Global X ETFs. Now, coming up, full coverage of the Jackson Hole Summit. We'll bring you top interviews and analysis. Of course, it's all about the currency market, so we'll look into that. The euro dollar yesterday below parity, currently at 90, I think about 91. Where's next? This is Bloomberg.
expect if they move in a way that's anticipated, another maybe 75 basis points, the next one, we don't know. There's some discussion about that. Then it will indicate that they're on the way. And I think what's most important now, and we've learned from history on this, learned from experience, is the more the Fed can communicate what its objective is. It would like to get back to 2% inflation. It needs to do this by a monetary policy that reduces inflation, doesn't reduce the growth of the economy, reduces inflation, the better off we'll be. So that communication, that stipulating about what the policy will be like is very important right now, and I hope the Fed does that.
John, when it comes to where we're at in the markets, we're seeing extreme bullishness, not so much today, but we've seen the rally just continuing to build. Over the years, for you, what role have financial conditions played, and should the Fed be paying more attention to this, or at least allude to that fact in order to sort of bring down this bullishness that we're seeing?
Well, they have to pay attention to the markets, obviously. They have an impact on the markets, and the markets have an impact on them. But I think that the more they are deliberative of this is what needs to be done, this is what's worked in the past, this is how we can do it, the more convincing it will be. And I think what the markets don't like is uncertainty about what's going to happen. There was more uncertainty today. I think that's one of the reasons why the markets went down. But the more that the Fed can indicate where it needs to be going, that's why these rules, so-called Taylor rule, whatever you want to call it, are advantageous, because it says, hey, we need to move a little bit further, and hopefully that will cure the problem more rapidly than people expect.
John, when you wrote about this in 1982, you flagged the scenario, right? Early deceleration risking the issue around credibility, and then the risk of really disinflation causing a recession. Given perhaps some of the policy errors before, does that mean we're at a point where recession is going to be maybe a likely cure for this bout of inflation?
I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher and higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people worried about. They're right to worry about because they've seen in the past, but the more that there can be a stipulation, this is what we need to do. This is good monetary policy. This will make the economy healthier. This will make a stronger growing economy. It hasn't grown that well recently, grown it even faster. And I think that's what we should emphasize. This is better for jobs. This is better for the economy. This is better. And also, I would mention the world economy. We have inflation all over the place right now.
Well, that was Stanford University economics professor John Taylor. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Saudi Arabia's energy minister says OPEC and its allies may be forced to cut output as the futures market has become increasingly disconnected from fundamentals. Prince Abdulaziz bin Salman told Bloomberg harmful volatility is disturbing the basic functions of the market. OPEC Plus meets next month to consider production targets. Now, British Airways says it's scrapping about 5,000 return flights in the coming months. That is after cancelling about 13% of its summer schedule due to a staffage shortage and extended capacity curbs at its London Heathrow hub. BA says passengers who have been affected can rebook alternative flights or even seek refunds. Now, Dr. Anthony Fauci, who became a household name during the pandemic, is to step down at the end of the year. The top U.S. infectious disease expert has run the National Institute of Allergy and Infectious Diseases since 1984, advising 7 presidents on every major infectious disease outbreak since the HIV crisis. The 81-year-old says he's leaving to pursue the next chapter of his career. The U.S. has warned that Russia is preparing to launch intensified strikes against Ukraine's government facilities in the coming days. This comes after President Vladimir Putin called the car bomb that killed the daughter of an ally a, quote, dastardly crime. Ukraine is preparing to celebrate Independence Day tomorrow, which also marks 6 months since Russia's invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, millions of Angolans will head to the polls in the oil-rich nation this week while we speak to the country's central bank governor. That's coming up next, and this is Bloomberg. Well, below parity recession fears and the energy crisis pushed the euro to a 2-decade low. European stocks and U.S. futures waver on rate jitters. Traders brace for hawkish Fed speak at Jackson Hole. Plus, OPEC on alert while crude gains after Saudi Arabia warns the alliance could cut production to support prices. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some UK data shortly. Of course, all of the talk is on that Citigroup note yesterday saying that inflation here in the UK, if you assume that energy prices go much higher and so the cost of living crisis is getting much worse, inflation could hit some 17%. A 17% inflation, given the Bank of England for the moment sees inflation peak at 13.3% just before the winter. It begs the question, of course, what does it mean for their interest rate peaking? I mean, are we looking at 6%? Are we looking at 7%? What does that mean for mortgage? I mean, if you look at mortgages and how much people, of course, are dependent on that, we could see a real crisis in the UK. All right, we're just getting those figures out in the UK. August manufacturing, 46. The forecast was for 51. So it's much worse than expected for manufacturing. Again, anything below 50, and we're at 46 is a contraction. Now, August services PMI falling to 52.5. That's a touch better than expected. The other story, of course, weaker pound, and you kind of just wonder what that endpoint is. Now, we earlier had some euro area PMIs declined. They declined for a second month, according to new PMI data just out. Now, they signal that fears of a recession may already be coming to pass as record inflation saps demand and weakness seeps into more and more sectors. Joining us now to break this down for us is Lizzie Burden. Lizzie, first of all, that UK, good morning. Manufacturing much worse than expected.
Yes, but you've still got growth in services and on the composite. It's the same as the Eurozone looking ahead, though. Bloomberg Economics reckon you're going to get a recession later in the year. You've already got consumer confidence at the level that's consistent with a recession. And what I would also point out is, just looking ahead, our economists reckon that the UK's recession will be milder than previous ones because you've got healthy household balance sheets, because we're expecting this fiscal stimulus from whoever is the next Prime Minister. But even, Liz Truss is saying that a recession isn't inevitable in the UK. Our economists say that all she can do is cushion the blow because it is coming. So the figures, I think, will get worse later in the year.
Yeah, I mean, that Citigroup note yesterday, though, was like really terrifying reading. I mean, I sent to everyone I knew saying like, oh my gosh, interest rates at 6-7%. Everyone was like, wait, what does it mean for my mortgage? What's the picture like in Europe?
So we've had a slew of data this morning. Let me start with France. It's slumped to the lowest level since that disruption earlier in the pandemic. Unexpectedly, Germany, though, has contracted again, but that was what we did expect because of its comparative higher reliance on Russian natural gas. More broadly across the Eurozone, there's contractions driven by manufacturing, but also you're seeing services like tourism grinding to a halt again because of the inflation impact. So a lot of data, but it heralds a difficult run into the end of the year for European economies. Analysts surveyed by Bloomberg do expect a recession. And again, it's a headache for the ECB because they're expected to continue hiking rates, even though the economic momentum is fading.
Yeah, and it's all happening on currencies. Thank you, Lizzie Burden, there with the very latest on the UK and European economies. Now, millions of Angolans will vote this week in a key election for the oil-rich nation. Angola's ruling party, in power since the country's independence in 1975, faces its toughest test yet against a rejuvenated opposition. Now, we're joined by Angola's central bank governor, José de Lima Massano. Thank you, Governor, for joining us in, of course, Bloomberg Surveillance today. Now, if you look at what some of the region as a whole, Africa has been particularly vulnerable to high food and energy prices. What can your central bank do to actually insulate Angola?
Hi, good morning, and thank you so much for having us from Central to us. A pleasure to be here. But as far as inflation is concerned, Angola, as you know, has been through a very demanding reform program. And ahead of the program here from our side, the central bank, we are also conducting a very restrictive monetary policy to ensure that we have prices at a stable level. And throughout this year, we are witnessing that prices in Angola are falling. Actually, we start the year with inflation around 27%, and today is 21%, and we expect by the end of this year to be below 18%. So the initiatives that Angola have taken in recent past, with all the reforms that we have introduced, and also including the ones related with local production, where we have seen also an increase of food in the market, I think is helping. So today, Angola keeps on importing quite a lot. On a monthly basis, we are importing something like $200 million of food. Has been reduced. If we look to 5 years ago, it was $250 million. So increase the level of production, restrictive monetary policy is helping Angola to contain inflation.
I mean, your inflation target is 18% for 2022. How much do you have to increase actually the price? Or how much do you have to increase interest rates to make sure that you hit that target?
We are okay, because today our basic interest rate is on 20%, and actually, as inflation is falling, we expect also interest rates to follow the same trend. So we are not under any sort of pressure to increase interest rates. Actually, we're going the other way around. As inflation is falling, we'll see in Angola also interest rates falling and offering more chances for local production to keep on flourishing.
So you're not expecting to hike rates. I think your next policy meeting is September 26th.
No. We are meeting now in September, yes, and we are not anticipating any increase on interest rates. Actually, in the last monetary policy meeting, we made a decision to reduce rates, and we expect that if things remain with the same trend, and now in September, we may see again interest rates falling.
I know Angola's debt burden has been falling, but I think you still owe about $19 billion to China. There's now talk about China waiving some of their debt to certain countries. Is Angola one of them?
Well, the Ministry of Finance is taking care of that. When it comes to external debt, I think the good news about Angola, as far from China, is that Angola is diversifying its sources of finance, and which is quite helpful. But then it's the Ministry of Finance, in our case, is the one dealing with China when it comes to external debt management, not the central bank.
But do you think there's a clear strategy for Angola to continue on the path to basically not sever those ties, but certainly diminish those ties with China?
Yeah, I think that Angola has to be open and has to keep on looking for opportunities. But the initiative that the country has been done in the last few years, and it also includes some of the reforms that we have introduced here in the Central Bank of Angola, where on the foreign exchange market, for instance, we remove all the bottlenecks that we used to have in the country. So today, it is no longer require any sort of licenses to import or export funds into the country. So it makes the markets more flexible, viable, and again, to us to have different and alternative ways to get finance, I think it helps.
I have to say your currency is pretty incredible, gaining more than 20% against the dollar this year since early 2022, which is one of the best performing currencies in the world. Will you continue to keep it free floating, or will you try and safeguard some of your exchange reserves?
No, we will just let it free floating. And the thing is that in the central bank, we are concerned with reserves, international reserves management. So we are our target is 10 months cover of imports of goods and services. We are currently around 8 months of coverage, and so still below our target. But we are not anticipating the need to intervene in the markets. We just let the market function the way it is. It's working just fine. So today in Angola, you don't have people waiting for opportunities to make payments abroad, coming and seeking the central. It's working fine, for instance. It's working fine. So,
Governor, what's behind the strength of the Kwanza?
I think, one is the monetary policy that we are conducting being restrictive, because in the past we used to have a very expensive monetary policy in Angola, and all the public inefficiencies at the end of the day and the need to additional finance were supported by the central bank. So it's no longer the case. We have a far more restrictive, more disciplined. Actually, one also has to be fair on the fiscal side. We can also see the efforts that authorities are making that, but on our front, it's far more disciplined. Then Angola is an oil-commanded economy. So with the hike in oil prices also helping the market. So the offer of foreign currency in the market has also increased. And also one has to recognize that all the initiatives to increase local production is also bearing results. So we are importing glass, which means that the currency has also taken benefit of those developments.
Governor, I want to talk to you about banks and the banking sector. You have 25 banks in the country, but I think 5 of them actually have the main market share. Are you expecting M&A and consolidation in your country?
Yes, we do. Actually, we have recently made a decision to increase the minimum capital requirements in Angola once again. It will come in force now in October. Yeah, but also we are witnessing that some of the banks, because it's not just a requirement for additional capital, it's that Angola has reformed the financial sector, and we have adopted most of our recommendations that are followed by European banks. So this is one of our preferences. So with all those reforms, the market is becoming far more demanding for commercial banks, and we are expecting mergers. But also, we have already seen some of the banks go into the stock exchange. So one of the banks has already.
I saw one, right? Yep,
yes,
that's BAE, Angola's biggest private lender. Who's next?
That's correct. We expect another one to be listed this year, Banco Caixa. They already have announced it. And early next year, we're probably going to have the third one. So it's happening.
You were appointed central bank governor in 2017. Are you ready to go for another term?
Well, yes, I'm very happy with the work that we're doing here. We are satisfied with the results, but to be honest, we are focused on the job that we have on hand. So we'll see how things go. But so far, our concern today is keep on doing the job that we are doing the best we can possibly do.
All right, thank you so much for joining us. José de Lima Massano, Angola's central bank governor, joining us for an extensive conversation ahead of the elections. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Apple plans to begin manufacturing the iPhone 14 in India about 2 months after the product's initial release out of China. The company has been working with suppliers to ramp up manufacturing in India and shorten production lags. The tech giant is seeking alternatives to China as Xi Jinping's administration clashes with the US government and imposes lockdowns across the country. Now, Elon Musk has subpoenaed his longtime friend, former Twitter CEO Jack Dorsey, in his legal battle with the social media giant. Musk is seeking to collect documents and data to show that Twitter understated how much of its customer base is made up of spam and robot accounts. Dozens of people have now been subpoenaed by both sides ahead of that expected trial in October. Ford is cutting 3,000 jobs this week to fund its shift towards electric vehicles. The cuts will come primarily in the US, with some positions also eliminated in both Canada and India. The CEO, Jim Farley, has repeatedly said the company has too many workers. Ford wants to spend $50 billion to build 2 million electric vehicles a year by 2026. And Zoom shares fell in US late trade after it projected sales and profit for the current quarter below estimates. It sees annual sales growing to about $4.4 billion, down from its projection in May of as much as $4.55 billion. Zoom's pandemic boom has cooled considerably as offices reopen and competition intensifies from Microsoft Teams. And that's your Bloomberg Business Flash. Francine.
Thanks so much, Leanne. Now, coming up, Chinese banks are said to be employing unusual practices to inflate their loan volumes. We look at what's driving that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, in China, some banks are inflating loan numbers as they struggle to meet government demands to pump more credit into the economy. Let's bring in our chief Asia economics correspondent, Enda Kern, in Hong Kong. So, Enda, good morning to you. Exactly what is driving this?
So the backstory here, Francine, is that in China's economy right now, there's no shortage of credit, no shortage of cheap loans, and the government is encouraging the banks to get money out there into the real economy. Now, the problem is, as the economy slows down, the appetite for borrowing among households and businesses just isn't there. So what our colleagues have picked up is that in the case of some banks, at least, what's going on is that they're lending out some money to some companies and then taking that money back in at the same rate in the form of a deposit. So it's kind of a money go around, and speaks to the idea that these banks who are being told to lend that money just can't find those customers who are willing to borrow it, because the appetite to spend and invest isn't there, against the backdrop, of course, of the big real estate slowdown and the ongoing restrictions from COVID-0. So it does speak to just how problematic China is finding it to get policy traction in the economy and to ensure that activity gets some momentum as we go deeper into the second half of this year.
So, I mean, this is not without risks. What are the main ones, Enda?
Well, I think the problem continues to be, Francine, at what point does the economy actually hit a bottom in China? The narrative had meant to be that July and August were supposed to see a turnaround, putting things on a better even keel heading into the back end of the year and heading into the Party Congress, but that's not happening. We saw a lot of fairly soft data last week for the month of July. Then, of course, we had the central bank cutting interest rates for the first time since January. Banks bringing down mortgage lending rates, but all of these steps speak to urgency among policymakers, but they don't speak to a turnaround in China's economy. I think that's what the big concern is right now, Francine, that there is this liquidity trap, that the issue isn't about the availability of credit, the issue is about why people aren't borrowing, and that's why there's a call for, or there's a sense that there will need to be a deeper and bigger policy pivot, maybe on the real estate side, or maybe on the COVID-0 side, to really jumpstart and rev up activity amongst households and businesses in China in the months ahead.
But and is this, I mean, could this just be caution and planning ahead, and so people are being very careful? Or could it actually suggest a credit crunch?
Well, look, there's always a sense of caution in a slowing economy, Francine. You are right. China has a very high household savings rate, for example. So it's not like there's a liquidity or credit crunch or anything like that in China. But at the same time, the problem is that policy is struggling to get traction. And every time the government unveils a new measure, it's kind of met with either another reversal on the COVID-0 side of things. We've seen ongoing recent lockdowns and restrictions, of course, on Hainan Island, which snuffs out kind of consumer confidence. And of course, on the real estate side, despite the steps that they have taken in terms of bringing down interest rates and getting money into the system, we continue to see a downward spiral in activity there. So the point is that none of the levers the government have pulled so far have been enough to turn things around, and that's what's worrying economists. We saw those downgrades from Goldman Sachs and Nomura last week to maybe sub 3% growth now for the year. That's a fairly shocking rate considering what people were looking for at the start of the year. So I think the expectation is now that we will have to see a fairly aggressive step up in policy over the coming months if we are to see stabilisation of growth. That is expected ahead of the Party Congress later this year. But the point is, we haven't seen it so far. The economy hasn't stabilised, and that's what's concerning a lot of observers watching this.
And thank you so much, as always, for the wisdom and insight. Our Chief Asia Economics Correspondent, Enda Curran. Now, coming up, Elon Musk subpoenas Jack Dorsey. We'll bring you the latest on the Twitter takeover battle. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk has subpoenaed Jack Dorsey and his defense against Twitter's lawsuit to make him complete his proposed $44 billion buyout. Now, the Twitter co-founder has long been a friend of the world's richest man. Well, Dorsey stepped down as Twitter chief executive last year and has since been an energetic booster of Musk's bid for the company. Now, he tweeted in April that Musk was a singular solution I trust to take over. Now, for more, we're joined by Bloomberg Quick Takes Alex Webb. So, Alex, first of all, are you still friends if you get subpoenaed by the other one?
I mean, it's hard to see how.
And don't subpoena me.
But I mean, presumably, you can be subpoenaed supportively. I don't know. But I guess the thing is that Dorsey, it seemed pretty clear, wanted or wants Elon to acquire
Musk,
Twitter. Elon doesn't want to acquire Twitter, so there's already some tension in the middle of that.
Yeah, but do we know that he still wanted to acquire it once Elon pulled out? Like, what role has he played?
We don't know. Like, unfortunately, the irony is that Elon shares far more on Twitter than does Jack Dorsey, and Jack Dorsey was one of the co-founders. So, no, we don't know Jack Dorsey's thinking. I'm intrigued to see what becomes public from this subpoena, from this session, because there'll be some fascinating conversations under oath.
So, do we have any insight into what Elon Musk is trying to find out with the subpoena?
Well, so Elon's whole case is built around this idea that Twitter overstated the number of accounts, or I should say understated the number of accounts that were bots. And presumably then he's trying to get data or admissions from Jack Dorsey that they knew that it was more than that. But I think ultimately the key thing here is Twitter, when it declares how many accounts it has and what percentage of those accounts are bots, it doesn't say the number of accounts total. It says the monetizable daily active users. So by definition, a bot is not monetizable. So therefore, it's probably excluding a bunch of bots already from that calculation. And then perhaps it thinks it might have not managed to suss out 5% of those.
But is the bots issue even really that relevant about why he's not buying it?
Well, not necessarily, no, because if you look at and Matt Levine, our columnist in New York, has made this case very compellingly that Twitter, in their filings, they say we think there's this number of bots. We might be wrong. If there's a better way of calculating it, we'd be delighted to hear it. Therefore, it isn't necessarily something that should be enough to stymie the deal or spike the deal. If they had misstated their accounts, for instance, they misstated their earnings, clearly that is something that is meaningful. But, you know, daily active users and monetizable daily active users are not part of generally accepted accounting principles. It's something that Twitter it's a metric they've invented on their own, and therefore how they can be wrong is hard to tell.
Yeah, what a story. I mean, producer Assad really has the money quote, "Friends don't drag friends into court," unless you're very bored.
I mean, the life of billionaires is very different, perhaps.
That's it. The life of billionaires is very different. Alex Webb there with the very latest on Elon Musk. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York. Anna Edwards is here in London. They'll have a full roundup of what to expect from Jackson Hole, that Jay Powell speech on Friday. Then we look at euro dollar. I know there's quite a lot of talk, of course, about equities, but if you look at where the big whipsawing is, it's definitely in cable. So we'll have, cable and euro dollar. We'll look at that. We'll also look at yen. This is Bloomberg.
Right now, central banks everywhere will take anything they can get.
It's almost like a sort of a hawkish sandwich around this mirage of disinflation that we see starting to dominate the narrative.
The Fed, and Powell in particular, needs to get across the message that the job is not yet done.
We're really playing a game where the market desperately wants the Fed to react.
Markets are not perfect, they're not always rational, and they just sometimes need to be given the alarm bells.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Federal Reserve overshadows the markets. European stocks and U.S. equities waver over worries about more monetary tightening. The big squeeze. Euro area economic activity falls for a second month in a row. Record inflation is sapping demand. And Donald Trump reportedly has more than 300 classified documents at his Florida estate. Some of those documents are said to have come from the CIA and the National Security Agency. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. Plenty of stories to dissect then, Kailey. Plenty to get the details on with our team shortly. But in terms of where the markets trade, European markets and US futures suggesting a little bit more optimism after the devastation of yesterday. Asia, though, that was a different story.
It was indeed. And of course, the day in the US and Europe is still young. So a lot could change over the coming hours. But in Asia, as you alluded to, it was decisively risk off. We had stocks lower across Japan, China, Hong Kong, altogether taking the MSCI Asia Pacific Index down for a fourth day in a row, lower by about 0.9% at its lowest level in a little over a month. And even Chinese developers, those property stocks, which have gotten what should be some supportive news in the last couple of days around more loans to this sector, really trying to prop it up, also couldn't get a bid. Those were down about 0.7% when it comes to our Bloomberg Intelligence Index of those stocks. At the same time, as you were saying, Anna, of course, we are paying attention to the central bank story, the hawkishness of them, and that has seen a lot of movement at the short end of curves across the world, including in Australia, where the 2-year yield rose about 7.5 basis points to its highest level in about 2 months. Finally, in foreign exchange, I would note you are seeing some outperformance from the Japanese yen today, stronger against the dollar by nearly 0.2%. Yes, at 137.26, that is still very weak relative to history, Creedy, but nonetheless, it shows that there's a little bit of a bid for that haven asset out there.
Well, speaking of a bid, I think you're really seeing that in the S&P 500 futures as well, but not with that much conviction. Take a look at this. The S&P futures up only 0.2%. I mean, it's pretty natural to see a little bit of green on the screen after the massive sell-off that we saw yesterday, and of course Friday as well, and really led by those big cap names. So to see that reversal once again comes to no surprise, at least when you're looking at it from a technical level. But once again, no real conviction, at least when it comes to the early trade here when looking at futures. And I would say no real conviction in the bond market either. You're looking at a 10-year yield at about 3% with no real change in the move, and also no real change in the dollar, even though it is hovering around record highs, Anna. And this is going to be really significant as we talk about the ripple effects that you start to see cross assets. At the end of the day, though, Bitcoin as that risk sentiment indicator, well, it's shining bright green, up 1.7% this morning, Anna.
A pretty mixed picture, Chrissy, here for European stocks. European equity markets kind of divided, whether you look at the sector breakdown, where we're kind of evenly divided between the gainers and the losers, or the geography here. The DAX, the FTSE MIB in Italy doing okay. A bit more negativity coming through in Spain and in the UK. You'll see that the Copenhagen market in Denmark is particularly weak. More on that in just a moment. The UK market then down by 0.5%. Yes, higher energy prices is giving a boost to some of the energy names in London, but then we've got some negativity surrounding some of the other heavyweights in London, such as the drug sector, which is weighing. This is the Brent crude picture, and this is lifting some of the oil companies here in Europe, up by 1.2%. The Saudis then saying that they might have to come forward, or OPEC Plus might have to consider cutting production. So is the disconnect they describe between fundamentals and what oil prices are doing, which is interesting in the context of all the calls we've had from Western leaders to increase oil production in months gone by. This is the euro down below 1 once again, so below parity, 0.9932, actually off earlier lows, which is surprising given the negativity we saw in the data. A second month of contraction, at least in the PMIs, for the Eurozone economy. It's not just Germany now, it's France also, with a number for the composite, which is below 50, which indicates contraction. But we saw the euro actually bounce off earlier losses as a result of the German manufacturing number not being quite as bad as anticipated. What was worse than anticipated was the UK manufacturing number, 46. We'll get more analysis from our colleague Lizzie Burton on this in just a moment, but 46 against an estimate which was much higher than that. So we might expect to see some weakness in the pound, not so, fairly resilient, 117.69 after a lot of recent weakness, of course. And this is the reason we see the Danish market under pressure. Müller-Maersk is down by 3.5%. The heavyweight logistics shipping business. We've seen Citi actually move this stock and the rest of the sector to a sell. They see an end to the exceptional shipping rates that we've seen in recent months, Kailey.
Yeah, and of course, shipping and the supply chain is in focus as we see those strikes at Felixstowe in the UK, Anna. So we'll continue to watch that story, as well as a number of other stories in the day ahead, including retail earnings, which will continue with Macy's reporting second quarter results before the market opens. We'll also be paying attention to energy. German Chancellor Olaf Scholz is in Canada to discuss closer energy cooperation with Prime Minister Justin Trudeau. They will hold a news conference at 6:30 p.m. New York time. Plus, we'll hear from Minneapolis Fed President Neil Kashkari, who is speaking at a Q&A session at a gathering of the Wharton, Minnesota Alumni Club. And finally, in politics, Florida and New York will both be holding primaries ahead of the November midterm elections. Creedy.
Yeah, Kailey, and of course, in the near term, though, what we're watching is going to be all about the Federal Reserve. Stocks down near the lowest levels of the month as investors brace for hawkish talk from the Fed. At Jackson Hole, joining us now is Ksenia Galushko, a Bloomberg Equities editor. Ksenia, thank you as always for joining us. What is the stock market reacting to exactly?
Well, it seems like the stock market is finally waking up to the risks of the hawkish Federal Reserve. So the rally that we've seen since July lows, which has taken the S&P 500 near a bull market, and the Nasdaq actually rallied more than 20% from lows. Now this rally is at risk because of the Jerome Powell's upcoming speech at Jackson Hole, where he's supposed to reiterate the hawkishness of the Federal Reserve as it fights surging inflation.
Ksenia, another factor of the markets that we need to focus on is the dollar dominance. And we've certainly seen dollar strength as such a big theme. I read one of our pieces today on the Bloomberg terminal, which suggests that it is foolish to fight dollar dominance. That must be a sentiment shared by many.
Absolutely. Yes, the dollar hedge is really one of the most popular trades right now ahead of Jerome Powell's speech this coming Friday. I mean, it is a haven instrument, and it is one of the most popular ways of defending your portfolios at the moment. What's also not helping the sentiment is the fact that the euro is really weak at the moment, and that's happening because of the weaker economic data that we saw earlier this morning, and also because of the looming energy crisis, which is really weighing on the sentiment in European assets. So the fact that some of its biggest peers are under pressure, and the same goes for Asian currencies, is really helping the strength in the dollar.
Absolutely, and expectations for Fed policy have a huge hand in that. Bloomberg's Ksenia Galushko, thank you so much. And speaking of the Fed, later this week, Surveillance will be heading to Wyoming, to Jackson Hole, for the Fed's annual symposium. Tom, John, and Lisa will be kicking off that special coverage on Thursday. Let's turn back to the economic data out of Europe now. The latest PMI data for August provides little comfort for the state of the European economy. French output is contracting for the first time in a year and a half, mirroring the trend seen in Germany. Joining us now to discuss is Lizzie Burden, our EMEA economics and government correspondent. Lizzie, what exactly does this data show us?
Well, Kailey, let me walk you through it because there is quite a lot. France has unexpectedly contracted. Germany has continued its contraction, but we saw that coming because of its reliance on Russian natural gas. And then across the Eurozone more broadly, you saw this contraction driven by manufacturing, but it's also in services like tourism because of the impact of inflation. So it heralds a difficult end to the year for the European economy. Our economists and economists surveyed by Bloomberg do see a recession on the horizon, and it's a headache for the ECB because, of course, it's continuing to hike interest rates despite this momentum coming out of the economy.
Yeah, a lot of people watching the energy story and asking just how weak the Eurozone economy gets then through the winter, Lizzie. A lot of people asking similar questions about the UK, and that manufacturing PMI number today certainly will give a lot of people something to think about.
Yeah, the UK is still in growth territory, but manufacturing took a real blow. Really, it's only a matter of time until the story catches up with the UK. You've already got consumer confidence here at the level consistent with recession. I should note, though, our economists are saying that a recession in the UK will be milder than previous ones because of healthy household balance sheets, because of the fiscal stimulus we're expecting from whoever comes into number 10. But still, while Liz Truss is saying that recession isn't inevitable in the UK, Bloomberg Economics says she can only cushion the blow. A recession is coming.
Bloomberg's Lizzie Burden, we thank you as always. Let's go from economics in the UK to politics right here in the United States. The U.S. government reportedly has recovered more than 300 classified documents from Donald Trump since he left office. According to the New York Times, that includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more. Joe, walk us through what we know. What's the latest?
The numbers are really the news here, Creedy, as there's so much we still have yet to learn about what exactly the Department of Justice and FBI were looking for. But the scale of this operation is giving us a better sense of why they sought this search warrant to begin with and conducted the search the way they did. The New York Times reporting the National Archives indeed found more than 150 classified documents in that first batch of material that was seized from Florida in January, including, importantly here, documents from the CIA and the NSA. The sensitive nature of what they found and Donald Trump's failure to comply with repeated requests to hand over more documents is essentially why they referred the matter at the National Archives to the DOJ. We should add that reports are surfacing now as well that investigators want access to more of the surveillance videos at Mar-a-Lago to see exactly who was able to access the areas the documents were stored in and when and why. Meantime, Donald Trump has requested the appointment of a special master to review the documents that were seized. It is unclear, Grady, if that'll be approved.
Okay, really fascinating developments there, Joe. Let's pivot to the latest on the attempts to revive the Iran nuclear deal. How much closer are we?
It's a great question. We understand that some gaps remain, but the report is of progress here. We heard from the State Department yesterday. Spokesman Ned Price says that they're actually seeing some progress in terms of some of the deal breakers, if you will, that Iran has pulled back from. We should note that Iran delivered its response to a framework drawn up by the EU last week. We're waiting now on the United States, which says that it's still looking through Iran's reply here. One thing that we know has been taken out of this and encouraging the U.S. government is Iran dropped this demand that the U.S. remove the Iranian Revolutionary Guard from its list of terror groups. That's not going to be on the table here, so it looks like we could have some movement. It's just unclear exactly what the sticking points are. The State Department says it will not work a day longer than it needs to in preparing a very specific response to what we heard from Iran, the EU's foreign minister saying that Iran's reply was reasonable. So let's see what the administration here in Washington has to say next.
All right, well, we'll look forward to your coverage of it. Bloomberg's Joe Matthew in Washington, thank you so much. And of course, you can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Zoom, a company we are very, very familiar with due to the pandemic. But as we emerge from the pandemic and people go back into the office, companies maybe want to spend a little bit less on this kind of software due to the softening macroeconomic environment. You have Zoom cutting their revenue forecast and also missing expectations from analysts. It actually reported its slowest quarter of revenue growth ever as well. So all of that together taking the stock down about 10% in early hours. It's a bit of a better earnings story, though, for Palo Alto Networks. This is a big cybersecurity company. It beat on its quarterly report and it beat on its forecast. So clearly a lot of demand out there in the cybersecurity world. It is up about 8.5%. And finally, I also wanted to check on AMC, of course, one of the meme stocks that has seen a lot of air come out of it over the last several days. This is actually a stock down 58% over the last 4 sessions, a 42% decline coming yesterday alone as its preferred stock Ape began trading. But you're seeing a little bit of a rebound coming into the shares of it as well as some of the other meme trades out there this morning. Anna, right now AMC up about 4.4% before the bell.
Our colleague Matt Levine out with a fabulous piece on meme stocks and where they head. Coming up on the programme, though, Kailey, Tom Caddick joins us, head of investments at Nedgroup Investments. We'll continue to count down to the Jackson Hole Symposium, of course, and Harvard's status as the richest school faces an oil-rich contender in the University of Texas. Our Big Take looks at how crude and natural gas, not fundraising or investing prowess, have positioned the school's endowment to dethrone Harvard. You can read more on that story at Bloomberg.com or by typing NI Big Take into the Bloomberg terminal. And it's Tuesday, so don't miss Bloomberg Crypto today with Kailey and Chrissy, of course, at 1 p.m. New York time. The weekly show covers the people, transactions and technology shaping the world of decentralized finance. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. We are simulcast on TV and radio. We've been seeing risk sentiment really take it on the chin across the board. The stock market, even treasuries, starting to see a little bit of a sell-off, and commodities, of course, taking it on the chin. But it all kind of points to one asset that is hovering at record highs. For our radio audience, we are looking at a chart here of the Bloomberg Dollar Index and the ICE US Dollar Index. You can really see this massive acceleration going into 2022. It's almost going, I don't want to say vertical, but it seems to be in that direction. And now is back up to those July highs, which, by the way, were an all-time record. The question, though, is the margin of the move. How much of it do you start to see actually have ripple effects in the stock market, in the commodities market? And what does that do when your macro hedge for a lot of investors is actually outperforming some of your core investments? We're going to ask Lynn Thomason, the Bloomberg Markets editor. She joins us now from London. Lynn, thank you as always for joining us. Let me put that question to you. What do you do if your macro hedge, your dollar trade, actually outperforms your stock trade, your bond trade, your commodities trade?
I'm sure that's a situation a lot of people are finding themselves in right now. And I think, you know, the chart just really speaks to the fact that the dollar is the one big trade that's working in markets right now, and it's consistently been working. And I think, you know, it speaks to, you know, the state of the global economy, where the U.S. is relatively stronger, and you're seeing weakness around the rest of the world.
A euro weakness is also a trade that, if you've been betting on that, that's also been working, I suppose, the other side of the strong dollar, Lynn. How much further does that have to go then, people suggest? Are we done pricing this in, or does it just get weaker from here?
No, I think the surprising thing is a lot of people see it coming weaker from here. So you've got plenty of forecasts. I know Nomura, Morgan Stanley are all sort of expecting the weakness in the euro to continue. And in some ways, it makes a lot of sense with the gas crisis continuing to get worse day by day, and the winter is still ahead of us.
That is absolutely true. And it felt like winter may have come for the equity market over the last several days, Lynn. It seems that the pain is taking a breather today. Is it a breather in the selling, or have we actually seen just the end of the rally?
I mean, I think maybe one way to look at it is the nervousness before the Jackson Hole speech, and, you know, just the anticipation for what that's going to bring. I think a lot of people are now expecting a hawkish turn and more, you know, whatever it takes to get inflation under control. And I think in that environment, people are very hesitant to put on more risk.
Okay, yeah, we'll wait for Jackson Hole then. Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function on the Bloomberg terminal to find the Markets Live blog. Plenty there on the stock sell-off that we've seen and dollar strength. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kailey Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Apple plans to begin making the iPhone 14 in India about 2 months after the product's initial release out of China. That narrows the gap between the two countries, but it doesn't close it completely, as some had anticipated. Apple has been trying to diversify its supply chain, but the company's high standards for secrecy complicated its efforts in India. Life expectancy in New York plummeted by 3 years in 2020. The CDC says that was the biggest decline among all states in the first year of the COVID pandemic. Residents of New York are expected to live to just under 78, the 15th highest life expectancy in the country. Overall, the U.S. life expectancy plunged by 1.8 years in 2020, the biggest drop since World War II. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. And hedge funds are unleashing record bets the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. So clearly, Creedy, all of us are waiting for that speech from Chairman Powell around 10 a.m. Eastern time on Friday. And yet we are seeing really decisive moves and repositioning in the market in anticipation of it. People aren't just waiting for what he has to say.
And you know what I think is so fascinating here is that this is a hedge fund trade, by the way, that is the exact opposite of the way the market interpreted the last comments that you really saw. This dovish pivot that it seemed like the stock market was rallying off, but at the end of the day, it's actually this interesting turnaround that, Anna, this seems like people are saying, well, actually, not only are they going to be not dovish, they're going to be even more hawkish than expected given those looser financial conditions.
Yeah, I mean, the Jackson Hole Symposium developed a reputation over years gone by, didn't it, for being an opportunity for the Fed to reset market expectations. But if the Fed thinks the market has the right expectation, then maybe it doesn't create so much news. But there is a lot of expectation then, Pretty, to your point, that we will see something hawkish. So I guess one way that things could surprise is if we don't quite get the level of hawkishness we'd anticipated, where would that leave markets and their long dollar positioning? We'll put those questions to Tom Caddick, who joins us shortly, head of investments at Nedgroup Investments. How does he position ahead of the Jackson Hole Symposium? What is he expecting Powell to deliver as his key message? We'll have more on that shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Federal Reserve overshadows the markets. European stocks and U.S. equities waver over worries about more monetary tightening. The big squeeze. Euro area economic activity falls for a second month in a row. Record inflation is sapping demand. And Donald Trump reportedly had more than 300 classified documents at his Florida estate. Some of those documents are said to have come from the CIA and the National Security Agency. I'm Anna Edwards in London, and Kriti Gupta and Kailey Leinz over in New York. Of course, Matt Miller is off today. And Kriti, U.S. equity markets, U.S. futures, European equity markets, kind of moving around a little bit this morning, a bit volatile, but really waiting for developments later on this week.
A completely wait-and-see mode, Anna, and I would say that actually nothing has really changed in the last 30 minutes since we did our last market check. You are seeing futures higher to the tune about 0.1%. And once again, this is pretty natural, just given the massive sell-off that we saw yesterday and, of course, on Friday as well, to see a little bit of a green on the screen. But once again, not a ton of conviction when you look at futures trading. Like I said, up only 0.1%. And that's not just a stock story. You're seeing it in the bond market as well. 301 on the 10-year yield. Does it hover around that key 3% level ahead of Jackson Hole? And when do we actually see that perhaps psychological level not really be that relevant anymore? That's going to be the question I have for a lot of our guests coming up just shortly. We also have the Bloomberg Dollar Index, which really is taking, it seems like, the cue of the bond market. Still higher, hovering near those July highs, which, by the way, are record highs for the Bloomberg Dollar Index. But today, once again, no real conviction. That might explain why you're perhaps not seeing such major action in the stock market, and I would argue in the commodities market as well. Bitcoin, of course, up about 0.9%, still at that 21,000 handle, Kailey.
Yeah, and we will be talking about that, you and I, later today on Bloomberg Crypto Kriti. So we will definitely watch those moves and watch how that is translating into crypto-related equities in pre-market trading as well. Because as you're seeing Bitcoin getting a little bit of a lift, these stocks are getting some much-needed relief. The likes of Coinbase up about 2%, and MicroStrategy, which is essentially a Bitcoin proxy because it holds so much of it on its balance sheet, is up about 5%. I also want to point out in other speculative areas of the market that you're seeing a little bit of life coming back into the meme stock trade. Bed Bath & Beyond is down more than 60% in just the last 3 days, but it's rallying by about 5.4% this morning. So no, it doesn't undo a lot of the losses we have seen in recent trading sessions, but nonetheless, a bit of a breather coming in. And finally, I just wanted to point out to Zoom, this is a fundamental story given it reported earnings after the bell, cutting its revenue forecast as businesses just aren't needing to get Zoom as much, considering a lot of people are back in the office. That pandemic era peak of Zoom, which we all got so used to, maybe is a fading story, and the stock is fading this morning as a result, down about 11% before the bell, Anna.
All those remote meetings, Kailey, that we learned to know and love in some cases. Let's have a look at what we've got on these European markets then for you. We're down around 1/8% on the Stocks Europe 600, pretty evenly divided between those sectors that are gaining, those that are losing, geographies that are gaining, those that are losing. Not moving anywhere in a hurry, it seems, on these European markets today. We have seen weakness in data coming through as a big theme, and that applies to the euro and the pound. We're watching both of these in response to PMI data. The European PMI data told a negative story, contraction for the Eurozone economy, at least according to this data set, for the second month in a row. It's not just Germany, it's also France now in contraction. But we do see the euro actually off earlier lows. It has been weaker than this. It was threatening to go below 0.99 a little bit earlier on in the European morning. But the German manufacturing PMI wasn't quite as bad as expected. I'm clutching at straws, but that took the edge off the euro's fall. The pound, 117.65. It has fallen quite a bit recently, but now fairly steady at that 117.65 level, despite the fact we saw a 46 print for the manufacturing PMI out of the UK, a shortage of labour and an inability to get hold of some materials, apparently, the driver there. And Brent crude, also worth a mention, actually ticking upwards after recent contraction, of course, in the Brent price, 97.67, then up by 1.2%, as we hear, Kailey, from the Saudis that they might have to actually cut back on production levels at the OPEC plus level because of the disconnect that they see between what's going on in the economy, concerns around growth dominating there, despite all of the calls we've seen from Western leaders to increase production.
Yeah, talking about that difference between the physical market and the futures market, and how it seems that futures are really underestimating the tightness of capacity constraints that are out there. So definitely a story to watch. We also, of course, are watching these equity markets, and joining us now to discuss them is Tom Caddick, head of investments at Nedgroup Investments. Tom, we have seen some pretty substantial selling pressure over the last couple of sessions. Is the rally, a bear market rally, if it was one, over?
I'm not sure about over per se, but yes, clearly what we're seeing at the moment is oscillating markets that are playing very much along the theme of, how tight and how hawkish are central bankers going to be. And that's what we've been seeing. That's what we saw yesterday. Fortunately, from our perspective, we're investors, not traders, so we can look through some of this market noise. But it's very much playing off this narrative of concern around hawkishness of central banks.
Okay, but it isn't just noise. If we're seeing interest rate hikes for longer, or if we're seeing bigger interest rate hikes than had previously been anticipated, Tom. So with that in mind, what are you looking for at Jackson Hole? We always expect a lot. I wonder if this is going to be one of those years that materially delivers, or will we get a sort of holding statement from the Fed?
I think it's going to be a holding statement. I mean, it just doesn't make sense for Powell, for the Fed, to be making a very, very strong statement in terms of hawkishness, when realistically it's going to be driven largely by the inflation print that comes through. They've already made that indication. So I think for Jackson Hole, it's going to be a holding statement, or at least keeping options open ahead of the next inflationary numbers, which are going to drive very much the expectations around base rates.
Well, let's talk a little bit about capital flows here. We talked about the fundamentals with Jackson Hole. In terms of capital flows, I think it is a foregone conclusion for a lot of investors here that ultimately the pain that you're going to see in Europe is just going to get magnified come the winter season. But I'm curious what that means for the U.S. stock market. Doesn't that mean that if the rest of the world is struggling, the immediate investment is to buy American? So why isn't that happening?
I mean, I would broadly agree with you. And our positioning has changed over the last 6 months or so on the back of this. We've got particular concerns around Europe, where I think some of those challenges that you've just said, Kriti, are particularly acute and would favor the US market, which is greater breadth. Absolutely has inflation been a major issue, but we've started to see signs of that peaking, or at least some early signs of peaking. We've shifted our positioning to more of a quality stance over value or indeed growth, but particularly also focused more on the US, where we would expect to see outperformance.
Is the dollar the best hedge, Tom?
As opposed to Bitcoin, absolutely. I do think I think it probably is, but we've seen a lot of strength coming through from there. As a European investor, it's been a good place to be in terms of dollar. But yes, I think it probably is.
And real assets, Tom, you make mention in your notes ahead of our conversation about the importance of real assets and how they're actually quite a conviction play for you, including in commercial property. I mean, for the novice, you think about a rising interest rate environment, you're not sure what that does to property, or at least you know that it creates headwinds. What's the lure of these of real assets right now?
So we've got multiple attractions in here, and it is looking for where to put your money. And we've softened our position on equity significantly. We do have a preference for real assets, or assets that have a strong and reliable compounding income generation capacity, plus some inflation protection, which is something that we've all been looking for some time now. But upward-only rental reviews. For us, you mentioned commercial property. If you're selective, being able to still buy into that reopening trade has been very successful for us, and I think that's got some way to go. Areas such as infrastructure, or indeed renewable energy, where we can get some protection from that rising energy price, where you've got a direct linkage to electricity prices feeding through into valuations. So we've been looking very much for a degree of stability, a lack of cyclicality in some of those positions, as well as then that inflation protection coming through.
Tom, you mentioned that the dollar is still the macro hedge to go to. You also said that you were overweight U.S. stocks, but I'm curious, isn't that a contradictory trade?
No, I don't believe so. This is, we're talking relative in terms of our positioning there. So we've got the positions there. We partially hedge some of that, but broadly speaking, it depends what your base currency is. So we're coming in to get US exposure. We've also got some of that dollar hedge coming through actually in our FTSE 100 positions as well.
Tom, thanks very much. Thanks for your time. Tom Caddick of Nedgroup Investments joining us there with thoughts on the markets. On a fairly quiet day in markets, but gearing up, of course, for Jackson Hole later on this week. It is August, after all. Coming up on the programme, though, a lot to talk about when it comes to labour market stress. We'll talk about UK strikes and the supply chain. Kate Jennings joins us, Logistics UK Policy Director. The focus of this week, of course, is Folkestone, the port of Folkestone on the east coast of England. What impact is that shutdown having on the economy? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Zoom Video Communications CFO Kelly Steckelberg. That's at 5 p.m. in New York, 10 p.m. in London. This is Bloomberg.
It is a kind of issue for the logistics industry and the freight industry and the shipping sector here in the UK. As Lizzie mentioned, Felixstowe is the UK's largest container port, but we do have other ports, so they'll help to pick up some of that slack. The issue is if you do reroute freight away from its traditional travel plans, etc., there would be a cost, and those costs will be passed on to importers, traders, and potentially ultimately consumers.
That was Richard Ballantyne, British Ports Association CEO, speaking to us yesterday about the strike at the port of Felixstowe. Around 2,000 dockers at the port on the east coast of England began an 8-day walkout on Sunday, halting the flow of goods through the UK's largest gateway for containerised imports and exports. Joining us now is Kate Jennings, Policy Director at Logistics UK. Kate, help us understand what kind of damage this does to the UK economy and the limits to that damage, actually, because of the types of things that we move around the world in containers and the other options that shippers then face.
Yeah, so first of all, I suppose the most important thing is that we hope the port will continue negotiations with the unions, because the best thing that could happen is that they reach agreement. But for a container port like Felixstowe, the majority of goods are not sort of just in time, they're not time sensitive. So what I expect has happened already is that the port will have brought forward some deliveries, they may have pushed back some deliveries, and they can reroute to other ports. So, for example, in the UK, you have London Gateway, you have Southampton, you have Tilbury, all relatively close in shipping terms to Felixstowe. So there is that capacity to move the goods by another route.
OK, so there is at least that capacity to move things around. How normal would you say logistics in the UK are right now, Kate? And define normal however you like, given we're coming through the post-pandemic period, we've been through Brexit and the shock that created, at least for the labour market. And now we're dealing with strike action, at least at Felixstowe and also perhaps in Liverpool. How normal is the logistics sector?
I mean, I suppose this is like the new normal, isn't it? What I would say is the logistics sector has come through Brexit and COVID really well. Consumers haven't really missed anything. There were short-term demand shocks, at the beginning of coronavirus, but the shelves were quickly restocked. And I think we have a very dynamic, very effective logistics sector. That doesn't mean to say, I suppose for 8 days of strike, I think we can cope with that. I don't think people will see the difference. But obviously there will be costs. There will be costs to hauliers who might have been expecting to pick things up at the port and now will have to pick them up somewhere else. Or, so communication is key here. What we've been saying to the port is it's really important that they communicate with the hauliers, they communicate with customers, so that we can minimise any impact as far as possible.
Well, Kate, you mentioned that a lot of these ships could just be rerouted to other ports. Is there capacity at the other ports to handle that extra traffic?
I mean, yes, absolutely. I would say there is for 8 days worth of strikes. It should be fine. Obviously it would be different if the strikes were prolonged. But I think we need to take these things step by step, don't we? And for the moment, I think we think this is manageable.
Kate, very quickly, what are we expecting here when it comes in terms of fiscal policy, for example? What can the government really do here to perhaps ease some of these issues?
Yeah, I mean, that's an important question. So as Logistics UK, we've asked the government to make a further reduction in fuel duty. You may remember there was a 5p fuel duty reduction in earlier this year, but that was quickly sort of swallowed up by inflation. And what you see happening is because inflation is going up, then the government's take on VAT is increasing. So our argument is that actually if they continue to reduce fuel duty rather than getting that VAT benefit, that will be better for cost of living, it will be better for business costs, it would help dampen inflation. So, we think a fuel duty cut would be helpful at this moment.
I wonder, Kate, if I could just ask you, in response to some data we got out this morning, what you see in the manufacturing sector, and clearly logistics operators will have a good sense of what's going on in that manufacturing space. We got a manufacturing PMI reading of just 46, which is contraction territory and really low versus what was expected. Away from that specific data point, I wonder what your experience at Logistics UK is telling you about the headwinds that the UK manufacturing sector faces right now.
Yes. I mean, I'm obviously aware that Brexit and COVID have had impacts on manufacturing. I can't say that at the moment that I know any more than you do, but it's one to watch, I think, isn't it? To sort of make sure those supply chains are supporting our manufacturing base.
Kate, obviously so much of the issues at play now come down to labor, and wages are a huge issue surrounding this strike in particular. But as far as labor ability in the logistics sector in the UK, are there enough people in the jobs?
That's a great question. So in Logistics UK, we're actually leading a campaign called Generation Logistics. Look out for it if you haven't heard of it. So what we're seeking to do is promote the logistics sector as a great place to work. I think a lot of people, are not aware of the range and diversity of opportunities available. And the fact that in particular, we did a report with Amazon recently, which highlighted that you can join the logistics sector with relatively low skills, but then there are opportunities to build your career and get into management positions. So it's a great sector to work in, and we're looking to promote that and attract people really to the sector.
Kate, thanks so much. Kate Jennings, Policy Director at Logistics UK, with her perspective on some of the disruptions that we're seeing to logistics in the UK right now. Later this week, Surveillance heads to Wyoming for the Fed's annual symposium at Jackson Hole. They'll be listening for the Fed and what the Fed has to say, what Jerome Powell specifically has to say about the state of the US economy, the level of hawkishness they intend. Tom, John and Lisa kick off special coverage on Thursday. This is Bloomberg.
I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people worried about.
John Taylor, Professor of Economics at Stanford University, of course, speaking with Bloomberg yesterday about how he doesn't see recession as needing to be part of the cure. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And also during that conversation, Tom, we saw him reference the Taylor rule. I do like it when economics professionals come on and sort of name drop the rules they devised decades ago. That no doubt in focus for you. What else is in focus?
Well,
what data?
John Taylor is very gifted. He was one of the first people to support me in what I do every day, Anna Edwards, and that is a gentleman who in freshman economics at Stanford dresses up as a raisin. He walks in literally as a raisin to show agricultural economics in Northern California, something that...
You see, that's an image that sticks.
I can see Matt Miller doing that, actually, but that's a different... We'll say that for a different day. This is a really important chart and shows a difference between Powell and Lagarde. I went back 30 years. The word is never. We've never seen this. This is the fabulous Bloomberg Financial Conditions Index in white for America, in light blue for Europe, and they have never, ever diverged, Anna, like we see now. There they are in tandem through the pandemic, and the European Bloomberg Financial Conditions Index is back to where it was at the worst of the pandemic. The U.S. recovers nicely and is accommodative. The divide is extraordinary.
Tom, I'm sure it's something you're going to ask your guests on your show later today. Who do you have coming up?
Well, we've got lined up mostly about the markets. Jan Hatzius will join from Goldman Sachs. We'll get an economic briefing from him. Obviously, pre-Jackson Hole briefing. We're scheduling our exit tomorrow. We're not taking the Gulf Stream. Very important. We are climate sensitive. We're looking at our footprint. Lisa demanded that. But we've got some other people as well. We will address Ukraine, and we will address the suburbs of Moscow with Tina Fordham of Fordham Global Insight.
All right, looking forward to it. Tom Keene, thank you so much. Bloomberg Surveillance coming up over the next 3 hours. But let's take a look what we're watching even beyond that. I will be watching the Fed's Neil Kashkari speaking tonight at 7 p.m. He, of course, is the Minneapolis Fed president. He's going to be speaking at a gathering of the Wharton, Minnesota Alumni Club. He has become firmly in the hawkish camp. He has said recently that he would like to see the Fed funds rate at 4.4% in 2023. So what kind of tone is he going to strike as we beat the drum toward Jerome Powell's speech at Jackson Hole on Friday? Is this a Fed that is going to be continually forceful in pushing back against market expectations that have turned more in the dovish direction, Creedy?
Yeah, and Kailey, at the core of that argument is going to be a very tight labor market. But guess what else is extremely tight? The housing market, which brings some of the data that we're going to get about 10 a.m. Eastern New York time. Really crucial. We're getting in some U.S. new home sales as well as the Richmond Fed Manufacturing Index also coming out, plus some of that PMI data. But really, it's those new home sales that I have my eye on, Anna.
Yeah, absolutely. So that'll be the data focus. In terms of the politics and how that weighs in on markets and economic expectations actually into the winter, I'll be focused on Chancellor Olaf Scholz, who's making a visit to Canada. It's going to be the second day of his visit. Here we see images of the first day. This is the press conference they gave on Monday. There'll be another press conference taking place today, as we said a little bit earlier on in the show. Can Canada help with Europe's gas issues? That's the big question going into this visit, I suppose. And maybe the answer is sadly not really in the short term, maybe more in the long term. There's been talk of regulatory barriers being overcome to increase exports of LNG from Canada. But remember, a lot of the production in Canada is in the west, and a lot of the export would need apparently to be in the east. And so there are challenges that remain in that regard. Today, their attention actually turns from gas to green hydrogen. So trying to reset the conversation a little bit, but still very much around energy. And it is those energy questions that are set to dominate the European economic debate as we head into the winter. That is it for the early edition. Surveillance is ahead. Tom, John and Lisa will be with you to take you through some great conversations coming up here on Bloomberg TV. This is Bloomberg.